we asked several Fed officials amid the volatility, and guys like Fisher and even Williams said no. It was only when the economic
Tests. Fed minute in one Fed meeting release in 1 minute.
This is going to be what we were talking about earlier, Brian. Some reduction in the sense of global risk that's out there. It was mentioned twice, as you said. It might be mentioned once or not at all. I don't think they go so far as to restore the balance of risk. They're not there yet. I think June is still a possibility for a rate hike. I don't know how much of a clue we're going to get in this season now.
Intraday Wednesday.
Would you agree, Scott, with the previous guest, and you got about 20 seconds here, which is that, you're welcome, buddy, which is, now you have 18.
But he's a smart guy.
He is, which is that the Fed needs to leave something on the table. They can't just close the door.
Oh, look, the Fed has to leave data dependency on the table. That's their card. And so I think they're going to tell us they're willing to maybe be a little more hawkish here, but it's all data dependent.
All right, well, ahead of the Fed, here's your setup, folks. You've got the Dow Jones Industrial Average up 12 points. Of course, Apple is this huge drag, but Exxon and some of the oil companies like Chevron also doing well. Exxon just raised its dividend, by the way, by 2 cents. The yield on the 10-year Treasury note is 1.89%. We're seeing the price of crude oil at $44.63. The price of gold, the last time I checked here, $12.51 per ounce. So really not much has moved. The market's in waiting mode, and we're going to wait here in just about 4 seconds. But Hampton, here's it again, the Fed decision. Hampton.
The Open Market Committee decided to leave the target range for the Fed funds rate at 1/4 to 0.5%. In determining the size of future adjustments to that target range, the Open Market Committee says it'll assess realized and expected economic conditions relative to its objectives of maximum employment and 2% inflation. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial and international developments. The Open Market Committee goes on to say, in light of the current shortfall of inflation from 2%, the committee will carefully monitor actual and expressed progress on its inflation goals. The actual path of the Fed funds rate will depend on the economic outlook as informed by incoming data. Turning now to the economy itself, since the last meeting in March, essentially the Open Market Committee sees an economy where labor market conditions have improved further, even as growth in economic activity appears to have slowed. Growth in household spending has moderated, although households' real income has risen at a solid rate and consumer sentiment remains high. Since the beginning of the year, the housing sector has improved further, but business fixed investment and net exports have been soft. Market-based measures of inflation compensation remain low. Survey-based measures of longer-term inflation expectations are little changed. The committee currently expects, this is the overview now, with gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate pace and labor market conditions will continue to strengthen. There was a dissent as far as this latest statement, voting against the action. Esther George, who preferred the meeting to raise the target range for the Fed funds rate from 1/2 to 3/4%. Back to you.
All right, guys. Hampton Pearson, thank you very much.
Enjoyed the show.
About 100 years of business journalism, we become Fed word counters. But Steve Leisman, this is, as far as I can tell, almost a cut and paste of the March one, with the exception of the economic activity appears to have slowed as the second sentence in the first one. The rest of it is almost exactly the same. Uber Dovish?
I'm looking for the global bid in
They used global one time.
So they reduced that just a little bit here, right? That's
They did. There was a 50% reduction in the use of the global in the word global
right.
2 times in the March.
So that's coming off the boil. And it really was that second paragraph that was the key there, Brian, where they said, however, global economic and financial developments continue to pose risks. That's out. So that is something that they could do in terms of creating a very gradual backdrop to a change factor. Remember, theoretically, the Federal Reserve is in a tightening cycle. Theoretically.
By not mentioning global as much, that seems to be hawkish in and of itself. Is the way, I mean, the markets right now are interpreting.
You know, hold on, Melissa, because it looks like they took it out the first time. Is it in there at all? Oh no, it is in the second one. They say indicators and global and financial developments.
Yeah,
So it's in there once, but it's a changed way that's in there. Otherwise, Brian, I want to just spend this time to agree with you here. It is very similar in that regard. And Melissa, I think you're right, but the market should expect this. And we'll get to Scott in a second. The Fed, in the absence of two things, one is worsening economic data, and two, in the absence of sort of lowering inflation, the Fed's going to set the stage to do another rate hike. It's not going to pull the trigger precipitously. It's going to give you a fair warning. This is a step in that direction, and it's the step I expected.
Right. Is it fair warning for June?
If the data come around, let's say you get another strong jobs report, let's say that, look, Scott, one of the big questions for investors, and this is what's interesting about this discussion because it goes beyond just the Fed, it goes directly to investing at this moment, is we saw how, can I use the word sucked in terms of earnings?
Yeah,
as they were
man. I said
in the first quarter.
Yeah.
So the question for everybody right now that has to do with both the Fed and with investing in the market is, do we get that second quarter rebound? I'll remind you of the work that we've done here at CNBC on this first quarter weakness that it has to do with seasonal. It had to do with seasonal adjustments. That may or may not be the case this time. But what we've seen, we had these weak first quarters. We had these nice second quarter rebounds. You had a real pain in the earnings place, in the earnings department. And if that comes back, then there's an investment proposition there. But it could come along, with another quarter-point rate hike.
I want to take it to the markets here and see how we are reacting to this statement. The S&P 500 is just 2 points below where we started going into the Fed decision. Where we're seeing the most interesting moves in the market, if you peel back the layers, is in the bank stocks. Take a look at the S&P Bank ETF. That's where we saw the spike higher. You can pull that up. The KDE is that ETF, and you're seeing it trade now up by more than 1%. So that was a definite spike higher on this which is why immediately, when I just took a look at the screen, the immediate interpretation is there's a higher rate
coming. Yeah. Well, let me give you my normal caveat, which is be very careful about interpreting the market's interpretation of the Fed.
Of course.
In the first couple of minutes, because right now, there are no human beings running the market. It is all algorithms and robots who are running this thing. And then a little bit, the humans will take over and they will control it. Right, Scott?
You got a human right here
Let's get to the human down at the New York Stock Exchange.
Is he really human or is Chu?
I believe so.
I'm not sure. I am not sure.
I'm a robot, guys.
Yeah, we know that. The way you
work, a robot. Simon, I'm sitting right next to Simon Hobbs, and I think we both agree that I'm a robot sometimes. I don't know if I'm really there, but I will. Simon's yelling at me right now. I will say this, though, to your point here about whether or not it's computers and whatnot that are trading it, a lot of professionals will tell you that the first few moments after this kind of a release or before a release are really going to be about order positioning. So the kinds of volatility that you see, the up and down movements, you'll notice, say, 10-year yields, 5-year yields, also the price of gold. We saw immediate knee-jerk reactions and now are moving towards generally where we were in those markets before the release actually came out. So yes, algorithmic or computerized trading has something to do with it. Also where people put their stop-loss orders or their profit orders, that has something to do with it as well. But as you take a look at where the markets stand overall, the Dow was modestly higher going into it, and now it's, yes, modestly higher after a few minutes here, 15 points to the upside. And then the 10-year yield, 1.88%, generally speaking, around where we were when that release first came out. So the market reaction here has been muted. I'd be interested, Melissa, also to see, you refer to those bank index ETFs, whether or not we see those spikes higher maintain that way.
And as we're speaking, Don, actually, if you look at the intraday chart, they are sort of getting back some of those gains, and we are seeing that interesting handoff to the high yields for the dividend payer stocks that have been moving this market higher so far. If the dividend yielding stocks are moving higher, then maybe there are some doubts amongst market participants as to whether or not that hike is coming in June.
Well, I think the question we have to ask ourselves about June is, will the Fed take into consideration the Brexit vote in the week that follows?
Great point.
Because I think if the surveys are showing this is close,
So they hold off.
They will hold off because they will not want to. If the markets have a lot of turmoil in Europe, I think the Fed would be loath to consider reversing itself.
But they can't say that. No. Janet Yellen, right, Steve? That she's not going to come out and say, well, but we will leave the EU. We might have
You
to
can imagine some of the brains at the Fed fashioning language that makes it clear that they're worried about potential global political developments that is a wink and a nod towards Brexit. I think Scott is right. It's a concern of theirs. If the polls, though, were to go the other way and show that Britain was to stay, June could be a potential opportune time. But again, I think the market is clear that we're data dependent and they're going to watch it. It should not be. I hope it's not trading with this idea that the Fed is never going to move, because if that's the case, then the market is potentially way offsides, and that's a danger.
Well, final thought before we go to Rick. Well, do you think, Steve, before we get to this June meeting, that they'll have enough data to take action, or do you think that if the economy were starting to look stronger, that they might very well just use that as the opportunity to signal that July was on the table and live for
They could do that. You've got two jobs reports. All of this thing that we're doing here at CNBC and the Federal Reserve Bank are doing about this GDP Now stuff is giving us a better real-time tracking as to where the potential GDP number is. It doesn't change the problems in the GDP number, but I think there are some better tools out there to know where we are, at least at this moment. So I think it's possible that they have that data. Look, it's got to be definitive. The Fed has already told us it's not going to make a mistake, with a marginal movement in the economy. We got to be back on this 2%. Yeah, right. Really good point. We got to be back on this 2% growth.
I know we're going to Rick. I just want to let the viewers know that the Brexit vote is June. I hate that word, by the way. June 23rd. The Fed meeting is June 15th, and right now the latest poll from the Telegraph shows only a 5% swing between leave and don't leave. So it's stay leaving. That's the exact error.
By the way, utilities and telecom right now close to session highs after this Fed decision.
All right, let's look at the yield on the 10-year note. Scott, thank you very much to you as well. Let's look at the 10-year note yield. It was yo-yoing in the immediate aftermath of the announcement, and there it is at 1.90, up a little bit over 1.90 change.
Ladies and gentlemen, Clueless 8 Trading, Frank, as you can see here, precision charts, a consolidation channel. Forecasting is some of the toughest business in the world, and we deliver it here at Clueless 8 Trading for a minimal cost every single month. Appreciate it, act on it, understand it, sign up for the advanced coaching sessions. And as you can see here, this videocast is a real-time broadcast as Santelli screams, and Clueless 8 Trading charts work their way exactly the way they should. Any break, remember, below the 2065 level on the E-minis is obviously a cautionary sign, in which case we're going to fall lower. Thank you for listening. Look forward to the advanced coaching sessions. Goodbye.